the Fed always cuts more than the market thinks. And that's really important to understand, both going up and going down. They cut or raise more than the market is predicting. So the market's predicting 4 by the end of the year. Maybe what if they cut by 6? What if we're talking about Fed funds with a 2 handle? Then that would be by December, January. Not expected, but if the economy really slows down, that's probably where they're going to be. And at that point, the 2-year bill will be all the way down there with it. So start diversifying, moving out the curve a little bit. That's kind of, the message. It's you don't have to do everything at once, and if you wait, you're never going to top tick the market, and if you wait too long, it's too late.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and host Adam Taggart. I welcome you all here at the start of a week. We're very fortunate to be joined by a co-portfolio manager at Real Investment Advice, Mike Lebowitz. Mike, how you doing?
Doing great. Thanks for having me on.
Well, thanks so much for coming on, and I want to give you props for pinch hitting today, Mike. We were supposed to be interviewing Judy Shelton today, and she had an unavoidable conflict come up at the last moment, and you were kind enough to step in. And I'm very glad that you did because there's some work that you've been doing of late that picks up on a theme that your colleague Lance Roberts and I have been talking about, which I described a few weeks ago as echoes of 1999, where Lance is saying that he is seeing degrees of speculation in the market that remind him very much of what we saw during the dot-com bubble. You've actually done some analysis to show that that's not just an opinion. We're actually seeing in the data a lot of similar trends in terms of where capital has been flowing in the markets that again provide sort of echoes of what we saw during the dot-com boom and then bust. So I want to dig into that with you real quickly. First, I just want to apologize to folks if I sound a little congested. It's because I am. I'm still getting over the flu that I got coming back from my trip to Ireland. I'm going to do my best to soldier through this conversation with Michael, but I'm going to let him do the majority of the talking, which I'm sure folks are happy to hear about. All right, Michael. So I do want to also talk with you about bonds. It's been a while since we've done a bond update on this channel, and folks are always asking me, hey, can you get Mike Lebowitz on to give us an update? So if you don't mind, let's leave a couple of minutes at the end for that. But why don't you walk us through what you're seeing in the markets right now? And I believe it all sort of starts with the action that you're seeing in high beta, low profitability stocks, correct?
Right, right. So kind of coming out, so the market fell, what, about 15% in April, and we hit a low, and the market bounced right back up, your typical V-shaped recovery that has become commonplace recently. And I was kind of, watching that, and you noticed that the rally back didn't feel quite the same as the rally in 2023 and 2024. And by that, I mean it wasn't the Mag 7 leading the way. It was other stocks, high beta, more speculative, a lot of companies not making money, but with promises of fortunes. And that as April kept going, that became more and more thematic. So I was like, maybe it's just me and I'm just noticing some of these companies up 20, 30% a day and some of these meme stocks. And, so I decided to kind of actually do the math
Right. And
and look.
sorry, Mike, but this is like meme stocks and like kind of the Cathie Wood type of tech stocks.
Cathie Wood stocks have been doing really well. Meme stocks are doing well. Anything related to crypto, Robinhood, for instance, Coinbase, uh, a lot of companies that have put AI into their names, and despite not being the Nvidias and the Microsofts of the world, but if you're AI oriented, the stock goes up. Again, similar themes as what we saw in the dot-com era. If you had internet in your name, or if you could somehow get dot-com into your corporate name, that was worth 40%, 60%.
Mhm.
So just seeing hints or echoes. Uh, and it's just over the last few months. Again, 98 to 2000 was almost two, it was about 2 years of high speculation. So I don't want to be alarmist either to say that this is playing out exactly like 2000, but we are starting to get that some of the similar speculative behaviors showing up. So, and this may be, so I wrote two articles. The first one really just talked about low beta and high beta and how a lot of it was really discussing the 98 experience. So just to set the timeline straight, from 95 to 98, we call that kind of the pre-boom period. That's where the internet was starting to become well known and people were starting to dream of what this wonderful internet could do for us. Little did we know in hindsight,
Mm.
the pros and cons. I mean, it works both ways, but I think we'd be flabbergasted to know what's evolved since then.
Right.
Then,
Undeniably transformative. Yep.
yes. In 1998, long-term capital and Russia defaulted. The market fell about 20%. And starting in roughly October of 1998, so long ago, October of 1998 to early 2000, the market just took off. And it was led by very speculative stocks. Before you got to that 20% decline, it was larger, profitable companies that were doing the heavy lifting. So you see the similarity. You got kind of your sort of Mag 7 between 95 and 98. Market drops as it just dropped because of the tariffs this time. And then it goes zooming ahead because of more speculative stocks. And then you have a bust. So 2023, 24, we had the Mag 7. That's all anyone could talk about, right? And what are those? The largest, most profitable companies. That they account for, what is it, a third of S&P earnings, 10 stocks or so. It's just crazy, but they're very profitable too. Then we had the tariff-related decline, about 15%. And coming out of that, it's not the Mag 7 leading the way anymore. It's the speculative stocks. So let me just show you with some graphs. I think it's easier than trying to talk through some of this. And I'm going to combine parts of my first article and my second article. My first article really focused on beta. And once I finished that, I really thought I should do more on the topic to help people understand how this may play out, but also to understand if it plays out like 2000 and we get a bust, where you might be able to hide. You don't necessarily have to sit in cash. Plenty of stocks did really well from 2000 to 2003. You just have to be able to rotate and actively manage your portfolio so that you're not stuck with the stocks that did well yesterday and poor today. You really want to just start assembling a roster of stocks that may do well tomorrow. Doesn't mean like a baseball coach, doesn't mean those players ever see the light of day. They never get to the batter's box or on the field. But having thoughts and a list of stocks ready is very helpful to anticipating what may come down the pike and noticing what's doing well and what's not doing well and when those start changing so you can be better prepared. So without further ado,
Super practical. Yeah. So I think folks are going to be really interested in this. So thanks, Mike. So as you're pulling up your charts here, let me just ask you to help me clarify for folks who might not be totally familiar with what exactly beta is. So when you talk about high beta and low beta, let me tell you my understanding of it, and then you can tell me if I've described it correctly or not. But
right,
a stock's or a securities beta is essentially its correlation to the general market. And so a stock with a beta of 1, if the market goes up by 10%, you would expect the stock more or less to go up by 10%. That would be a beta that's very tightly correlated with the market. If a stock is a high beta stock, 2, 3, 4 beta, then the market goes up 10%. That stock should go up 20, 30, 40%, right? Depending upon its essentially beta multiple to the general market. So that would be a stock with a positive beta correlation, correct?
yes.
And then
So
a negative correlation would be the market goes up. If I've got a negative beta to the market, you would expect the instrument to actually go down. And so a big part of your job as a portfolio manager is to try to build a portfolio that has different correlations to beta so that you've got diversification, right? You want some things that are correlated with the market, some things that are very correlated with the market, but then as hedges, you want things that might have a negative beta, correct?
Right. And you want to shift the importance of those factors over time. In an up market, you may want to shift to more higher beta. Market's going up and these stocks are outperforming to the upside. And conversely, you want to shift to lower beta when the market is going down so that you get less exposure to the market. And it's just all part of our, we talk a lot about rotations within sectors, within stock factors. And this is just another way to rotate. This is stock factors. So, Adam, let's look at some graphs. I think it's much easier to show visually than to talk through beta and some of the other factors and what happened in 98. And then we could do a quick comparison to today. This is beta. So I'm going to show basically three types of graphs, and you're seeing two of them here. And I'm basically breaking out the different time frames and how beta performed. And the data I'm using breaks out all of these factors by decile. And we're primarily focused on the first decile and the 10th decile. So that means the top and bottom 10% of stocks meeting those factors. So beta, it would be the top 10% of stocks with the highest beta and the stocks with the lowest beta. And in this case, the decile 1 is the lowest beta, decile 10 is the highest beta. So if you look at the graph on the left with the orange and the blue, and just again, focus on 1 and 10, you can see that from in orange in 98 to 2000, high beta was up 111%, and low beta was actually down a hair. It was down 0.72% over those 2 years. But now if we zoom out, going all the way back to from 98, so the boom, but also the bust to 2003, you could see that low beta stocks, despite going nowhere for those 2 years, were up 35%. Conversely, high beta, which were up 111%, rose a measly 2.65%. So pretty stunning. And you can see it on the graph on the right too, that during a boom, it was high beta. And as you dropped in beta down the deciles, it underperformed. So that was one of the dominant themes in 98 to 2000 was beta. You wanted as much exposure to the market as you could get. The riskier, the better. Um, so now let's move on.
All right,
And
and sorry, I just want to underscore one thing there because I've heard this before. I just want to make sure folks get it, which is sort of like when you're in a speculative mania, we'll say, and that's where things got by the end of the dot-com bubble, right? Think of it if you're a fisherman. I grew up in New England, and when the bluefish were running off the coast, you could just see them snapping at the water. And bluefish fishermen would say, you don't even need to put bait on a hook. You can just throw anything in that feeding frenzy and they're going to bite it, right? And so when you're in a speculative mania in the market, it is the most speculative stuff, meaning almost in some ways the junkiest of the junk, right? The stuff that is just the most specious tends to perform the best. Like the more craziness it has behind it, its narrative, the more people kind of want it when the animal spirits are running crazy like that. Am I
right.
underscoring the right thing here?
Exactly. It's really a gauge of sentiment. You could use this decile analysis for beta as a sentiment gauge. And my guess is it would track somewhat closely with other gauges of sentiment. Basically, investors don't perceive there being risk. And look, if there's no risk, you take the most chances, right? Why wouldn't you if there's no risk? But unfortunately, there's risk. And just because it doesn't appear like risk is knocking on the door, there's always risk that will eventually show up to the party. The cops always show up at the party, right? At the high school party. It's just a question of whether it's 9 at night or 2 in the morning.
Right.
So,
And this, I'll just mention this so you can address it later on as you explain all this, which is um, there's there are choices that you can make during this time. Like if you're seeing this type of mania as an investor, you can say, you know what, I've seen this movie before. I'm just not even I'm leaving the party now, right?
right.
Or you can use the Chuck Prinz logic, which is, hey, as long as the music's still playing, as long as the cops aren't here yet, I'm going to keep dancing. I'm just going to keep an eye on the door. Maybe I'm going to ask a friend to watch the street to see if he sees the flashing lights coming so I can be one of the first people out the door, right? And look, obviously one strategy is safer than the other, but kind of to a point I think you're making there, Michael, which is, if it's still 9 p.m. and the cops might not show up till midnight, like there's still money to be made if you want to play the game. Just understand it's a risky game and you got to put risk management in place. And so I always think back to John Hussman's quote with bubble markets. We said they force you to make a decision. Look like a genius now or look like a genius later, right? And if you decide you're just going to leave the party now, which is totally fine, just know that you might be gritting your teeth through a couple of months or quarters or maybe a year or more of idiots making a ton of money and basically laughing at you while they're just loading their pockets with easy gains. Right now, of course, you said the cops always show up, and so the key is to not be there when the cops show up or not be around when the bubble bursts. But I guess where I'm going with all this is um, there's a simplistic way to play it, which is just not to play, right? But there's maybe a more nuanced way to play it, which is not to go full bore, completely, crazy, blindly long, but to say, I'm going to still try to play some of what remains on the table here, but I'm going to do it in a risk-adjusted way so that if things start to turn, I've put in some safeguards to not lose my shirt. And I think that's what you're going to sort of talk with us about here, where there may be ways to play this and get involved in other different types of assets here, that if the party does turn, your exposure to the downside risk may be lower.
Right. And that's something you've heard Lance, I'm sure, over the last couple of weeks talking about managing the risk exposure, taking some profits from the winners, making sure you have diversification in some of those boring stocks like your Procter Gamble's, other stocks that have just been laggards. Healthcare is a great example of a sector that's really been lagging. So you don't want to go full bore, but you want to acknowledge this is the market we have to invest in. And it's not just going to flip overnight. There will be technical signals. You will sense the change in sentiment. And again, that could be tonight or it could be 2 years from now. So the job as we kind of get into riskier and riskier territory, or maybe we don't, but if we do, is get closer to the door. Understand how you get out. Understand where your risks are and where your risks aren't, and what you're willing and able to change when the time comes. And that's the best way to prepare for something that may or may not occur. And if it doesn't occur, so what? We're prepared, just like you're prepared for other calamities in life.
Yeah, and again, the thing I wanted to score here, and this is why I think what you're about to do is so important, is, Lance, more than anybody, reminds us that, look, if you're just constitutionally don't want to deal with this type of risk, absolutely, move into cash is fine. But what's really hard to do once you exit the market is to time your way back in. And what happens to a lot of people who do self-eject totally from the markets is once the market actually starts going back up again, then you start finding yourself stuck, right? Where you say, well, look, I was worried about valuations, but now the market's moved on me. Now I'm even more concerned that I've missed the gains and I'm going to get in and there's going to be a correction. So I'll wait for the next correction and then the market keeps going up. And you basically just miss out on, cycle after cycle of gains. And, Lance is, you know, points a lot to people who will still call you guys and say, like, I've been out of the market since 2008 and I haven't really been able to find a good way back in. So I'm not saying don't get out of the pool if you constitutionally are just uncomfortable with where things are. I'm just saying it's hard once you do, if you're all out, to have your plan to come back in. So following a plan like Michael's about to walk us through is a good way to stay in the pool but de-risk.
And be more comfortably do it more comfortably. You know where how to get out of the pool, and you know what you may invest in instead of panicking. Panicking is the worst thing you can do. So, Adam, we're going to move on to growth versus value. And on the top left, I'm kind of introducing a new way of showing this other than what we did with beta. And I created an index, so to speak. And I just took the ratio of the growth price to the ratio of the value price. Again, the top two deciles. And if you look from 2005 to 1995 to 2003, the trend is up and then downward over time, meaning that growth is underperforming value. But you can see from 98 to 2000, growth grossly outperformed value. And the two other charts show you something very similar. And I just realized one of my faux pas in these articles, an article is kind of has the graph and then words and then graphs, so you can kind of get away with my mistake. But when you line them up next to each other, what you'll notice, the graph on the top right is blue. It should correspond with the blue below, but it actually corresponds with the orange. So
Hmm.
don't I apologize. And if you take a good look at it, you'll notice the difference, which I just
We'll
did.
forgive you that chart crime.
Chart crime. So if you look at the bottom graph, I think that really says it all. It goes from 98 to 2003. And again, growth is on the left, values on the right. You could see that growth over that whole period, despite doing really well during 98 to 2000, was down 14%. Value was up 110%. So had you just stuck with value, you would have been miserable in 98, 99, and early 2000. You would have been much better off. And the graph on the top right shows that from 98 to 2000, growth did really well. That 10th decile of value actually did okay, but you can see 5 through 9 underperformed. And you can see the market was certainly preferring growth to value.
Yeah, and
Um,
an easy way to sort of say this is as folks get nervous, right? Once the speculative fervor starts ebbing, folks want, conservative safety, and that's where value is, right? So it's just the
Right.
pendulum swinging from essentially greed to fear, right?
Right. Exactly. Um, and then we can look at small cap versus large cap. And small caps are actually considered riskier, but more diverse. They're not as correlated with the market. They all have a lot of those companies have their own unique aspects, so their earnings don't necessarily sync as well with the economy as large cap companies. So the graph on the right is kind of what we've seen, right? That market cap, the highest market cap stocks did the best, and the lowest did the worst. But again, as you can see from 98 to 2003, you go through the whole cycle, small cap, the smallest of cap stocks, were up 200%, and the largest cap stocks were down a little bit. So, these charts are all showing you this is most profitable. Now we're going from least profitable to most profitable.
Hmm.
And you could see the same trend that from 98 to 2003, the least profitable companies did the best. They were up over 100%. Decile 10 is the most profitable companies. They were pathetic. So, but again, over time, it was the most profitable companies outperformed the least profitable companies. So you had a trend, you had an anomaly, and then you had a new trend. And the question is, what part of those trends and how did you play them is what really mattered for your returns. And this just summarizes it. The from 95 to 98, the market wanted the largest and most highly profitable companies. There's nothing wrong with that. That's a healthy bull market. You're putting your money in the Microsofts and Nvidias today, the companies that are really doing well, that are just kicking out massive profits, that have potential for massive profit growth. We can debate on their valuations all day, but they are highly profitable and they're proving it. They are investing a lot of money today, but they're also generating income today. Then we had the dot-com boom from late 98 to 2000. It preferred, didn't really necessarily want it, but invested in low profitability and the highest beta stocks. So it wanted risk. The riskier, the better. And I remember back in those days, and there was a stock a day that wanted to be in .com, that wanted to be involved in the internet, even though they were had nothing to do with it. The stock would be up 30 or 40%. And then we had the bust. And that's where the market kind of gravitated towards value, higher profitability, lower beta, smaller size, and value. So we can now, the table at the bottom kind of looks at what's been in favor in 2023 until the market fell off in April of 25, and then just over the last few months. And you can see that growth from 2023 to 25 and high size and high profitability. So the Mag 7, that's what's been driving the market. It's been extremely obvious what's been going on. We've talked about it. You've had numerous people, including Lance, talk about that theme over the last 2 years, right? But if you look at the on the right, it's high beta and profitability are doing the outsized returns. Growth value and size have been relatively on par with each other, but there's certainly higher beta is better and lower profitability. And these are returns over those periods. So, Adam, but what I want to stretch is this is a 3 month, 4 month theme. The question we have to understand is, will it develop into a full-blown mania like 98 to 2000, or is it just a theme that's going to kind of go away and we're going to get back to a more better market breadth where everything is kind of traveling with each other and this kind of fades? I don't know, but having this knowledge helps you appreciate whether we're getting more risky or less risky. And the more risky we get, the greater the odds that this cannot sustain itself and that you get a sharp, I'm going to say rotation,
Hmm.
because we don't need the market to collapse but we can have the S&P kind of go nowhere, but we can have these speculative stocks really get killed and value-oriented companies really rise in price. Again, because some of these market leaders, Nvidia is 7, 8% of the market, so is Apple, so is Microsoft. They are making money. They're making good money. So you could have a case where they really don't get killed and they can kind of keep the market higher, along with some of your more value-oriented companies like Lilly, like UNH potentially, or CVS, or some of those type of companies, while some of these high-flying names just get killed. So uh, that's what these articles were about. You could go to our website, check them out, and put words with these graphs and see if it makes sense to you. What I actually this morning I came with the idea. I was looking at UPS. UPS stock is the same price it was basically at the bottom of the co in March when COVID basically shut the economy down and people were just scared. They were scared to order stuff in, they were scared to leave their house. The economy was shut down. It's at the same price then as now. So I'm going to look at a few stocks, well-known companies, stocks whose prices are basically back to the same level as when the world was ending. And take a look at them and try to appreciate if some of these may be tomorrow's winners. They may be the value, the profitability companies that the market's going to be looking for when it starts shedding speculative stocks. So stay tuned for that one.
Okay. And Michael, when I talk to Lance every week, um, he talks about having a shopping list of companies that you guys are looking to add to, as on dips as valuations get a little less stretched. Do you have a list right now of those kind of
We do.
lower beta, high profitability stocks that if and when you think a rotation looks like it may be happening, you want to start increasing more into?
Oh, absolutely. We do. And we talk about them a lot. We talk about, a lot. We have rosters of all kinds of stocks because we don't know what's going to happen, but we want to be prepared and be following stocks and look to those stocks. Even if we don't buy some of the stocks, they're clues. They help us. We may never buy UPS. I haven't even done the analysis on it, but UPS may be perfect and we may buy it. But if nothing else, when UPS starts outperforming the market, that may be a sign that there's something changing. Why are investors reaching for UPS? And so that's, if nothing else, they provide an indication, and that's incredibly valuable.
Okay. Well, let me ask you this. So what, asking you to guess here a bit, or to speculate, what are some things that you think could um, puncture the enthusiasm for these high beta stocks? So, um, right now there's a lot of, yeah, I guess I would say the market sentiment is, uh, um, the AI trend is going to continue on steroids. So anything AI related, right, is going to do well. Um, the Fed is probably going to have to uh, pivot here at some point and start cutting. I think expectations for rate cuts are up substantially since the last Powell presser the other week. And so they're probably expecting, an additional goose from cutting rates. Um, what would what do you think would stymie that? What do you think is the kind of thing that would get somebody to say, you know what, I'm going to take some money out of this frothy high beta stuff and start putting it over in value?
It's an incredibly, I can't give you a good answer. I mean, I could lay out 10 economic scenarios or financial or war, or I could name a bunch of scenarios. But at the end of the day, what we find with kind of speculative errors with bubbles is that they just die because they just run out of steam, they run out of gas, and something happens. There's always some event that's what caused it, but that's not true. They just ran out of steam, and whatever event happened at that time, that's what caused them.
Gets the
If the
credit.
market
Yeah.
would have fallen 50% on tariffs, well, why did the market fall? It's 50%, but because of tariffs. But that's not the real cause. Not to say that there aren't things that can happen that can do that. There certainly are. But to try to anticipate it, it's hard. I think the one thing that kind of that I think a lot about is kind of the president's role in the economy, and the market has a lot of confidence in him, it appears. So, what could puncture confidence in the president and in his ability to keep the markets going, even though it's not necessarily him, but to keep the speculative fever? So that's something I think about. Like, what would change the much bigger, I know half the country hates him and half loves him. What would cause 75% of the country to all of a sudden start fading that and change the economy and really get people to understand there is risk. So that's one thing. But we could name potential wars, we could name tariffs, we could all kinds of things, Fed action. But I think what you just have to realize as an investor is that a speculative period will go on longer than you think it will, higher than you think it will, and seemingly pop out of nowhere, even though the market will assign something to help explain it.
Explain it. Okay. So let me ask you this. And look, there's a whole bunch of black swans out there that by definition, we're not going to know which one, emerges, because if we did, it wouldn't be a black swan.
Right.
Let me just talk to you about a white swan. Um, so your colleague in crime there, Lance Roberts, it has been pretty clear in the past couple of months saying, hey, there's more and more signs this economy is slowing down. He's not saying crashing. He's not saying going into recession, but he's saying slowing.
Mhm.
Um, and, we have interest rates and bond yields that are still quite high on a relative basis, relative being the past 20 years.
Mhm.
And honestly, they've stayed higher for longer than most people. Lance himself, when interest rates started, hiking, I remember him saying, "Oh my God, they'll never get above 3. The economy just can't take it," right? So obviously the economy was more resilient in that standpoint than we thought. Now, of course, we shoved a whole bunch of trillions in there, so that didn't hurt. Um,
Right.
but the longer that we hang out in the sort of higher for longer environment, that is just this grinding weight on the economy. And we're going to get I think the latest retail sales at the end of this week, so we'll see how the consumer's faring there. But I think we are seeing more and more signs that the consumer really is getting near the end of. I don't want to be too extreme about this, but that they are getting uh, more and more weighed down in their ability to service their debts. For sure, we're seeing delinquencies
Right.
and defaults spike. Um, Consumer spending has been, pretty flat for a while now, and like I said, we'll see the latest numbers at the end of this week. Um, so, we're seeing bankruptcies, corporate bankruptcies, I think at the highest they've been in a long time this year. We are starting to see, layoffs pick up again. So what about just a white swan of just grinding economic, a grindingly slowing of economic growth here?
I think I think yes, certainly that can happen. You'd be a fool not to say that a weakening economy can't hurt the stock market.
Right.
But I
And would
think
it drive this rotation that you're saying from the highly
just
speculative to the value?
potentially, there's been ever since COVID, there's just been a boom in speculation. You see it in sports gambling, you see it in like the poly markets now, you see it in crypto, you see it everywhere. So a lot of that speculative investing is not based on fundamentals, right? It's based on hope. It's, that this company is going to be the next Nvidia or Microsoft. And maybe it will. Most of them won't be, but maybe it will. So it's more speculative. So I think a grindingly slowing economy, which we've had for a few years now, it's become a little more pronounced recently, may not do it. I think what you need is a sharper decline. So the unemployment rate spikes to 5% in 6 months or above. GDP is negative. Companies are truly laying off people. Right now, the labor market is it's like the real estate market. There's nothing happening.
Yeah, it's frozen.
Right? In real estate, except for you, there's no one selling, there's no one buying. Right? In the employment markets, very few people are getting laid off and very few people are being hired. And there's just it's just kind of status quo.
Can I add just one thing for you to address in your rest of your answer here, which is, again, your partner Lance, I think makes a good point, which is, to your point, the economy's been slowing for a good while. The reason why it hasn't mattered is because GDP growth on a quarterly basis was so high from all the COVID stimulus. So we've had this long mountain to come down, right? So
That's
even though
right.
it slowed a lot, it was coming down from a high peak. What he's saying now is okay, the danger we have now is now we're a lot closer to the ground, right? We have a lot less altitude. So, another blip downwards does put you in more danger of actually impact, right? And so to your point, hey, if the employment rate were to pick up by, a couple of dozen basis points or whatever, that's more meaningful now than it was a year ago or 2 years before then, right? So we are a little bit more vulnerable now.
Right. The unemployment rate is what, 4.2%?
Yeah.
That's still historically very low. It's either 4.1 or
I
4.2.
think it's 4-1 actually. Yeah.
May have upticked the last meeting, but it doesn't matter. It is what it is. Payroll growth is only averaging like 30,000 now. That's weak, but it's still not declining. ADP growth is averaging 30,000 or so. So again, it's kind of stagnating. The economy is
Okay.
stagnating, but it's not quickly moving.
Right. And by the way, unemployment rate's 4.2. I just checked. You were right.
Okay. So I think a sharper change in the economy and, probably in a weird way in the economic data versus the economy itself, because I feel like the markets are more clued on the data than the actual economy. I feel like a trader or investor can see all his friends getting fired and not care until he sees it in the employment data. And oh, it ticked up from 4.2 to 4.5. I'm out, despite seeing signs all around them that there's certainly weakness. Um,
Which is so funny because that's two things on that. One is it's the opposite with consumers, right? Consumers don't really care what the newspaper says. They just care what they see happening. My neighbor lost his job. I'm going to cut my spending then because I'm more nervous, right?
Right.
Wall Street, to your point, doesn't care until the BLS data suggests that it's an issue. Which
Well,
brings me to go ahead.
just real quick. Lance and I were hammering this about the job market. It's weaker than we see. And for the last couple of months, we've been pointing out other things like ADP, for instance, or
Right.
continuing jobless claims that are telling us there's something amiss between the BLS and those figures. And then all of a sudden we get massive revisions and BLS catches right up to those. So, again, and I think the Fed is really guilty of following the employment data way too much and not nearly enough on other sources of data.
Right, boots on the ground stuff. Well, what's so interesting about this is I have been bitching with Lance and you and many other people on this channel for years about the poor quality of the data, particularly coming out of the BLS. And was some of it politicized? Maybe, right? Probably. Was a lot of it probably caused by just the bullwhip effect of how distorted the data got during COVID with the massive amounts of hiring and firing and stimulus poured in the economy? Absolutely. I think their job is probably a tough job. Um, but we've all said, look, a lot of this data is almost useless. And it had been touted, though, by whatever administration was in place, as long as it was in favor of the current administration. And then now, all of a sudden, we've got Trump saying, this data sucks, and I'm firing the person who compiles this, the BLS, right? And so I'm just curious, like, what are your thoughts right now on just the value of this data? Because Trump's kind of, you know, just shouted that the emperor has no clothes. I think a lot of people would agree with him. Now, I don't think Trump's doing it out of the goodness of his heart to say, "Hey, I think this data is suspect." I think he's just saying, "I want the data to point in the direction I want it to point in." So he's got his own agenda. But I mean, are we in a like have we ever been in a position like this where we just don't trust the dials on our cockpit?
I don't know. I mean, we've always been of the school of thought where we're looking at all available data, and part of that is private data. So, for instance, like we've been warning about this coming slowdown, despite the BLS telling us we don't know what we're talking about. And sure enough, it turns out we do know what we're talking about. The BLS is using surveys, ADP is using actual data. So why the BLS doesn't, you want to Doge something, you get five good programmers and a couple economists and figure out how to use data from ADP, from paychecks, from whoever else does, salary services. Use that data. That's real data. Use tax withholding. That's real data instead of surveys of, people and of corporations, which can yield any kind of result. No one's accountable for what they tell the BLS. It's same with inflation. I think they use, I'm going to butcher these numbers, but the BLS uses 100,000 data points. Sounds pretty legit, right? Till you consider that true inflation uses daily prices for, I want to say 1.7 million.
Right.
I'm butchering the numbers, but the ratio is about right. Why not just have a model like Trueflation that's just getting as many prices as you can and stop with the hedonics and stop with all the games they play and using averages and this and that and just have a number. If it's a little volatile, it's a little volatile. So be it.
So in 2025, when everything is digitized and our code base is very mature, we know how to do this. What is preventing all this, right? I mean, it seems like we could do this in a weekend almost.
Well, here's how many people work at the BLS. I don't know the answer, but I'm guessing it's a lot. And how many people are responsible for data gathering and reporting numbers? I'm sure there's other functions at the BLS, and I don't want to belittle it, but like I said, I think you could get a few developers, some AI, a couple economists, and just people that are generally aware of how data and economies work. You could say 10 people, and within a week, you could probably get the data you need to get you a more robust employment figure than what we have now. It's kind of pathetic that we haven't been shifting in this direction as our over the last 15, 20 years as our data analysis and computers and everything has gotten really uh, more advanced.
All right. Well, maybe that's the silver lining of Trump kind of lopping off heads here, where it just hopefully elevates, some of the antiquated ways of doing this, and in the kerfuffle, hopefully
And
somebody says, well, hey, look, there's a better source. Why don't we start prioritizing that?
well, and here's the other really tough part. This data, like trueflation, every day they put out an inflation number. This data should just be real-time data that's
I
just
know.
constantly flowing. And why tomorrow's CPI? Why is that such a big deal? That, it's already delayed. It's reporting on data from the middle of July, so it's already delayed by a month. And some of that data is using data from June, May, April. It's antiquated that a private sector service like Trueflation can do much better than the BLS, which is fine. But why does the market only care about the BLS? It's not the most pristine data. It's nowhere close to real time. And then if it comes in at zero point 0.2, that's good. If it comes in at zero point 0.3, that's bad. And given all the games that are being played with that data and just the frailty of the data itself, it's shocking that the market cares that much about a tenth of a basis point. And it's really not even a tenth because they round it. So it could be, less than that. It usually is less than that.
So interesting point, and then we'll move on. So, there's a lot of people who say, look, we shouldn't have a central bank in general, or the Fed's overstepped its mandate and had mission creep and all sorts of things, and we should have a market solution for setting interest rates, right? And I'm actually fairly sympathetic to that. But to your point, Michael, like, we could have all sorts of new real-time sources for a lot of the inputs that a central bank uses to make its decisions. So we could both, improve the inputs going into the system, and then we could have an intelligent AI that looks at them and says, hey, this is what the recommendation is given all the inputs that are coming in. We think policy should be X, right? And so, I mean, you could pretty much make a central bank kind of like an AI, based solution that maybe there's an FOMC that just checks the recommendation and debates, okay, do we want to do what the AI says? But it could be a lot more simplistic and get back to like what Axel Merck, who comes on this channel with me every time the Fed speaks to make sense of it for all of us. He's always criticizing the Fed for not having a framework. He's like, if the Fed just said, look, this is the rule set that we use, and this is generally when we pull the lever this way or we pull the lever that way is when the data is here or here, we could all have transparency into the system, right? Well, if inflation's here and the unemployment rate's here and these are the trajectories and these are the inputs, the market would pretty much be able to anticipate what the central bank decision is going to be because everything's clean and transparent and up to date.
Mhm.
Do you think we're probably moving to that type of solution just on a kicking and screaming basis?
I think in order to get to that solution, you need data sources that the Fed will trust. I think there are data sources, but they're not apparently using them. So, it starts with a good, this is model-based Fed policy, which has been argued for decades they should be doing. And even on the Fed site, you can see where there are Fed models versus what the Fed's doing. Like they even show some of these Fed models. So, I just think now's the time. Let's just redo the Fed. Let's rethink what the Fed is and isn't. I think I'm sort of a libertarian at heart, but I do think there is a time and a place for the Federal Reserve.
As like a
But
lender of last resort, right?
a lender of last resort, exactly. And, manage the daily flows like in some of these overnight markets that are incredibly important to the economy, to the financial markets, to the health of the banks. Regulating some of the banks someone has to do it because we know what happens when no one does it. So there is a role, but being, the almighty with the power of Fed funds And whether whatever they do is political or not political, it's based on judgments. They've been proven to be wrong over and over and over again. Bernanke in early 2008 saying everything's okay. Powell with his foot on the gas in 2021, despite the fact that supply was shut down and demand was starting to pick up like crazy. I mean, they kept interest rates way too low through the Bernanke and Yellen era. I mean, you can go back in time too. They flooded the market with cash before Y2K for potential technical problems with the turning of the calendar. That just fed that bubble we were talking about earlier. Fed has made a lot of mistakes. So if you can get to more of a model based with better data sources, that would be much better. And ideally, look, I'd rather the market set its own price for overnight money and the Fed just comes in when it kind of gets out of bounds a little bit. But you have to disrupt the whole power structure. Unfortunately, in Washington, where I'm at, people love power, and that's both sides of both political parties. They love power, and everyone involved loves the power. So they're not likely to cede power to anyone, especially a model.
That and there's the expression in academia, which I think also holds very true in government, which is uh, progress advances one funeral at a time, meaning just the old guard does it its own way. They have their own preferred data sources, things like that, and they don't
Right.
really give it up. And so it's only after the new crowd has come and brings
Right.
their new way of doing things with them, and they eventually displace the old crowd basically through dying off.
Right.
All right, so look, fascinating discussion. Would love to continue on it with you, Michael, but I got to land the plane, and it's providing a good segue into the bonds discussion. So um, the bond market's kind of been, ping-ponging back and forth in this range, low fours, 4.5 for a good while now. We know that the administration would love nothing more than to punch below four decisively and to get those longer term interest rates down. Um, what's going on here? Is the bond market basically just kind of in a wait and see to see if tariffs are going to have any inflationary impulse that the Fed is going to have to react to, um, or just, hopefully at some point the Fed says, nope, we're not worried about it anymore. We're starting to cut rates, and that's going to start bringing yields down all across the curve. What do you think?
I think the tariffs are just the bearish narrative of the day, right? There's just been a bearish pull over bonds for the last couple of years, and we've talked about the term premium and how it's been elevated now for 2+ years. So what's dragging on bonds is the deficit. I know the deficit's not the issue anymore. It's tariffs. It's supply of treasuries. It's whatever it is. The market's just latching on to excuses to be bearish on bonds. Um, what drives and what's important to recognize is what drives what bonds. So, what the market do today? And your answer would probably be, oh, the S&P was up 12 points. That's great for the S&P, but there's 500 stocks, and I bet you some were up 5% and some were down 5% and all points in between. So when we talk about the bond market, it's a little misleading to say, oh, the 10-year yield fell 2 basis points today because it doesn't tell you what the 3-month bill did or the 2-year or the 30-year or all points in between. So when you kind of look at bond yields as a spectrum, what you find is that the very shortest of bonds, so today's August 11th, if we look at a bond maturing August 18th, next Monday, it's a 1 week bill. That yield is solely a function of liquidity. Where will overnight Fed funds trade for the next 7 days? The Fed's presumably out of the picture. They're not going to, their next meeting's not till September. So it's a functional liquidity, and that bond yield is barely going to move, if it does move at all. Then you look at a 30-year bond. It's the opposite. It cares about what the Fed's doing, cares about inflation, cares about deficits, it cares about the term premium, it cares about money flows, it cares about a lot of things. So the long end is affected by what the Fed's thinking, but all these other factors. So when you're deciding where you want to invest, if you want to invest in bonds, it's not just by the 10-year, because that's what everyone talks about. You go on CNBC, what the 10-year yield do? You want to you want to make that investment based on I have a lot of faith that the Fed's going to cut rates, but I have no faith that the narrative's going to disappear and all of a sudden bond bulls or bond bears are going to get bullish. So in that case, you want to kind of stay at the fronter, the front end of the curve.
Yeah, the shorter
Um, Right. If you're in the camp that, look, this economy is weakening and I think we're going into a recession and I think that these bond bears have been kind of proven wrong on a few things and that they're going to flip and as money market yields fall, the chase for yield is on and those narratives go away, then you want to be in the long end. And as those factors change, you want to adjust your duration and how much you own. So about a month or so ago, we sold a little bit of our 7 to 10 year duration bonds and we bought kind of in that 5 year, 3 to 5 year sector. And we've gotten a lot of questions on it. Why do you lower duration if you think rates are coming down? And we do think rates are coming down. What we did was we lowered our duration, but we bought a little bit more of them. So on an equivalent basis, we didn't really drop our duration all that much because we added more bonds to the shorter maturity. And what we're really saying is we have a little more confidence that the Fed's going to be cutting rates and probably more than the market thinks. Because when we did that trade, the market was thinking maybe one cut by the end of the year.
yeah.
Now we're up to three or four or whatever it is. And I've even heard, kind of the word 50 basis points at the September meeting being mentioned. So, we've quickly turned from maybe a cut if we're lucky to could be three or four by the end of the year, if not more. So you can kind of skew your bet a little bit. I'm going to bet a little bit more on the Fed, and I'm still worried that those narratives just won't go away. They're just persistent, those bugs. So that explains kind of our gentle shift. Not a big shift, but a gentle shift towards reflecting that view.
Okay, so let me just make sure I understood what you said there. So you do think the Fed is more likely to blink here and start cutting. You're not entirely sure that the bond bull bears are going to give up their worries. And so uh, because the Fed controls the short end of the curve and not the long end, you're buying more in that sort of, you know, mid-tier duration because it'll be
Right.
influenced more by the Fed's uh, cutting than the long end will. So you want to pick up your pop there from the Fed cut. Let's say it plays out that way. Obviously, you're going to make your future decisions based upon what the reality is on the ground at that point in time. But would your expectation be to then start moving out further on the curve, thinking that the bond bears will eventually have to capitulate if indeed the economy is slowing and the Fed is cutting for a good reason?
Potentially. I mean, we'll see as the curve steepens. So as shorter term yields fall versus longer term yields,
Yep.
the the reward, the incentive for moving out the curve gets bigger and bigger, right?
Right.
If the Fed drops rates to 2%, your money market is 2% and your 2 year bill is 2.5%, and it's still four and a quarter or so, give or take, for a 10 year, people are going to want to start locking that in.
Yep.
So they'll start buying those down. And we've seen that whenever we kind of get these short-term peaks in yields, there's some really strong buying from the pension funds, from the insurance companies, from the true end users, not speculative people, but investors that are more than likely going to hold these bonds. They want to lock in those yields. So that could be a very bullish impetus that could get long-term yields down significantly if we're going into a recession, or even if just the Fed's going to cut. But at the same time, you could make the argument, oh, the Fed's cutting, that's very inflationary,
Hmm.
regardless of whether it is or isn't.
Yeah, absolutely. Okay, so you're raising a really big question, which I wish we had time to do justice to, and so I'm going to have to flag it for later. But there's a lot of people out there, and I assume a lot of people watching this video, and I'll include myself in this group, who have really taken advantage of the T-bill and chill trade over the past couple of years. So if that trade is potentially at risk of going away in the relatively near future, like let's say the Fed cuts 4 times this year, right, and then keeps cutting into next year, all of a sudden, to your example there, if short-term rates go down to 2%, right, or less, it's the attractiveness of that trade goes away. And so you have to ask yourself, what do I want to do? Right? Do I want to ride that down and just stay in T-bills but get a lot less for it? Do I want to start deploying that into something else? Maybe some of these low beta, high value, high profitability companies that you were talking about earlier. So I think a lot of people are going to be faced with a choice of what do I do? And doing nothing is a choice. That's a choice to ride the T-bill and chill trade down. So um, unfair, but do you have any quick thoughts about that? And obviously, this is something that somebody could. I talk about the free consultations on this channel. This is something that somebody could reach out to you guys at RIA and just say, hey, look, this is my situation. What options make the most sense for somebody like me? Correct?
Yeah, please do ask us. I would be happy to help you. Look, I think the answer I'm going to give you is very similar to what I told you with the speculative stocks. Have a plan. Start doing trades now. Like, one of our trades over the last couple of weeks, we've done a couple times is we've taken profits and we've used some of that money to put into some of our more conservative laggards. So we are doing a very slight defensive rotation. So if you have, 90% of your money in the T-bill, why not take 10% out and buy a 1 year or a 2 year? At least lock in some longer rates. Look, and if you're wrong, you're wrong. And T-bill rates stay where they are, you're wrong. But if T-bill rates go down, if the Fed cuts all the way down, the Fed always cuts more than the market thinks. And that's really important to understand, both going up and going down. They cut or raise more than the market is predicting. So the market's predicting 4 by the end of the year. Maybe what if they cut by 6? What if we're talking about Fed funds with a 2 handle? Then that would be by December, January. Not expected, but if the economy really slows down, that's probably where they're going to be. And at that point, the 2 year bill will be all the way down there with it. So start diversifying, moving out the curve a little bit. That's kind of, the message. It's you don't have to do everything at once, and if you wait, you're never going to top tick the market, and if you wait too long, it's too late. So do a little bit now. If you own 100% of Cathie Wood's ARC portfolio and you've done incredibly well over the last few months, sell 5% of it and buy, pick a conservative stock, buy Berkshire Hathaway, diversify, protect some of the money you've made. You're never going to nail the tops and the bottoms, but you can start adjusting as you get closer to tops and bottoms.
All right. Really good advice. And obviously, the best answer is one that takes the person's individual situation into account and the other assets they own, their risk tolerance, their goals, their time they have left in the market, all that kind of stuff. Which is why, folks, I always recommend that unless you've got a lot of successful DIY experience, you bounce these ideas off of a good professional financial advisor, ideally one that takes into account all the issues that Michael has talked about for us here. All right, Michael, well, look, I can't thank you enough for today. It's been a great discussion. I'd love to, next time I have you back on, it'd be great to really roll up our sleeves and talk about kind of the end of T-bill and chill if you're willing to really, get into the meat of that with me. But thanks again for stepping up to fill Judy Shelton's shoes. They're big shoes, and you've done a really good job today of stepping into them. Folks, please show your appreciation for Mike doing that by hitting the like button and then clicking on the subscribe button below, as well as that little bell right next to it. Yeah, if you would like to get some help in figuring out how to position your portfolio for the end of T-bill and chill, highly recommend you consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses, maybe even Mike himself and Lance there at RIA. To do that, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple of seconds, and these consultations are totally free. There's no expectations involved. It's just a free service they offer to be as helpful as they can to folks. Mike, thanks so much, my friend. Always great to see you. I'll let you have the last word here.
Just don't, this goes back to politics. And I was with some friends this weekend and they were like, how can you, they were on the liberal side and they were like, how can you be invested in this market? How could you trust Trump? And my response was, as an investor, you have to separate yourself from your feelings, from your politics. And you have to follow the trends, right? Do I think this high beta trend is sustainable? No, I don't. But it is what it is. And that's the market we have to play in. And this is the political system that we have, whether you love it or whether you hate it. You have to dismantle your investment decisions from it. So I urge you to just try to step outside of your own box and really just evaluate the situation for what it is and not what you think it is or how you favor certain things. So,
Very well said, my friend. All right, Mike, thanks so much again, and
yep,
look forward to having you back on the channel again soon.
yep, absolutely.
All right, and everybody else, thanks so much for watching.
It means that the government has to start building stockpiles. And so it's another buyer, and it's a big buyer. This is a really big, big buyer. But again, this will also, like, who else uses silver? Companies like Tesla are going to have to start stockpiling now because they will know that there are higher prices in the future. Well, anybody that uses a lot of silver in production of goods needs to take a position now and protect themselves from triple-digit silver and gain that same leverage over their competitors. This has the greatest gains in absolute purchasing power. And that is what matters, is value, not price. And so we're looking at the price. It's up $1,000 this year. But is anything else up 48% this year? Not real estate, not stocks, not Bitcoin, nothing.
Since the government must now build silver reserves, it becomes a major new buyer in the market. At the same time, companies like Tesla, which rely heavily on silver, will likely start stockpiling as well, anticipating higher prices ahead. Any business that uses significant amounts of silver should secure supplies now to shield themselves from triple-digit prices and gain a strong edge over competitors. Mike Maloney is a renowned precious metals expert, educator, and founder of goldsilver.com. He explains that governments always find ways to tax people, either directly or through inflation. History, like Weimar hyperinflation, shows how war spending and money printing quietly destroy wealth until it's too late. As people save in fear, devaluation builds, only to erupt in sudden inflation when money flows back. Gold-backed systems once restrained this, but fiat currencies lost all discipline. Today, massive money creation and QE enrich the elite while draining ordinary savers. Gold remains undervalued, but the system will eventually face a reset. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
True, but the problem with government is they will just tax us more. Silver could go to $1 million an ounce, and they're just going to take as much as they can from the population in two methods: the regular tax and inflation tax. And as they print for war, I did a lot. When I was writing my first book, my study on the Weimar hyperinflation was a stack of books about a foot high. And I had assistants. I didn't read all of them. I'm dyslexic. They read them and they highlighted stuff for me to look at. But we did a very intense study on the Weimar hyperinflation. During that, with World War I, when there's war on your soil, you have a lot of anxiety, and every dollar you earn gets saved. So none of it is in circulation, and it allows the government to keep on printing and printing and printing, and you don't see the dilution of the currency supply. You don't see the devaluation of the currency until the war ends and the anxiety is lifted. And the minute some of that currency comes out of hiding, back then you would stick it under your mattress, not put it in the bank. But once it comes out from under the mattress, look out, you're in for a hyperinflation. And so, yes, it'll make war more expensive. But if we are having war, the population will start doing more saving, velocity will slow down, and the result is that the government can very secretly steal a majority of your wealth without you knowing it until it's too late. And that's what using gold used to do. And then we went from 100% reserve ratio. First we had gold. Then we had gold notes 100% backed. And then we introduced the Federal Reserve and it was 40% backed. And then the Bretton Woods, and it dropped eventually to 8%, but there was no specified reserve ratio. But gold standards opened the door for this scam to all happen again. And so I hope we don't end up, I can tell by what countries are doing around the world that we are headed towards some sort of monetary system that has gold connected to it. Is it going to be another gold standard, or will the citizens of planet Earth wake up and say, no, we're going to use something real and that stores value? And fiat currencies have proven that they don't store value, and mathematically they can't.
Mike Maloney highlights that when manipulation breaks, the free market always wins, whether under fiat, digital currencies, or any system. True wealth isn't measured in unstable prices but in value relative to real goods like gold, oil, or wheat. Fiat money and floating exchange rates distort prosperity, stealing lifetimes of potential growth. History, like Weimar Germany, shows how loss of confidence leads to hyperinflation, where people rush to trade currency for anything tangible. In such times, gold rises faster than everything else, gaining real purchasing power. Today, with gold up nearly 50% this year, outpacing real estate, stocks, and even Bitcoin, it's clear that value, not price, is what matters. Now, let's get back to the interview.
Yeah, and that explosive phase change is when the free market overwhelms the manipulation, and it always has and it always will. It doesn't matter if we're in some digital currency system. It doesn't matter if they lock us in a jail cell and put us to work and extract wealth from us that way. It doesn't matter even if it's the matrix. The free market will overwhelm it. You and I spent a lot of time creating a chapter for the great gold and silver rush of the 21st century. And it's something that I dubbed Wealth Cycles back in 2010, I think. And we measured like everything that we could measure where we could get data that goes back into the 1800s. And what we discovered there, what's going to happen? Yes, the old measurements, if you're using currency. Ratios? No. It's impossible for the ratios not to stop working. Once you use ratios, you are getting rid of the currency. That's being taken out of the equation. When you measure your house value of your home in barrels of oil, ounces of gold, bushels of wheat, tons of iron, pounds of copper, shares of the Dow, when you do that, you start seeing what true value is, not price. We have to stop measuring things in price and start measuring the value of things. Steve Forbes, there was a great animation that our animator Aiden did for Steve Forbes when he was in Hidden Secrets of Money. And he talks about, what if the foot changed every day? So 11 inches one day and 14 inches the next or whatever. Or if you're trying to bake a cake and the clock change, a minute is 40 seconds one day and 90 seconds the next day, things become impossible. Well, that is the US dollar. And all these floating exchange rates severely limit our prosperity and has stolen part of our lifetimes. You can absolutely prove that when you create greater prosperity, a population will live longer and be happier. This is just fact. And so, and you cannot go back in time and repair transactions that didn't happen or prosperity that didn't happen. And so these fiat currencies, these floating exchange rates, have shortened your lifetime and my lifetime. They absolutely have. And this is something that is provable. I had you insert a chart after this of the Weimar hyperinflation, simply because this looks like the Weimar hyperinflation. Yeah. Now, if you look at that early part from the end of World War I up until the beginning of 2020, if you make a chart of just that is it's a pre-hyperinflation. I remember we were interviewing Jim Rickards, and I was telling him I had discovered this pre-hyperinflation I was all excited about it. And he goes, I didn't know I was here for a history lesson. So anyway, that first phase was a conditioning that happened to the population. That loss of 90% of their purchasing power, this is a 90% loss in purchasing power, taught them that if they hold on to currency too long, so the second time that they saw this happening, that's when they started buying anything. A case of doorknobs will hold its purchasing power better than the currency. And so that's what caused that change in public perception and the introduction of fear of holding on to the currency for more than a few seconds caused that endgame hyperinflation. But the point is that gold is going up faster. Every chart looked like this. Real estate looked like this. The stock market looked like this. Everything in Weimar Germany looked like this, except gold was going up at a factor that was greater than all the other things. So it was gaining in purchasing power during this. And it was in my first book. Go back to the Japanese yen chart one more time, the tab before this.
Math.
And Japan has been stuck in basically a deflationary environment or stagflation during that whole period of time. Prices of real estate and stuff are not keeping up with gold. If gold quintupled, it's probably tripled or quadrupled in purchasing power of real estate, businesses, and anything else you want to buy. Cars have not quintupled since 2007. So that's a real good measurement. How much is a car since 2007? Has it doubled? Well, that means you can get 2.5 times more cars with your gold. Than a year. That's since the beginning of the year. So we just started the 9th month.
Yeah. Yeah.
Is there anything else going up this fast? And the answer is no. It's at this point for this year, this has the greatest gains in absolute purchasing power, and that is what matters is value, not price. And so we're looking at the price. It's up $1,000 this year. But is anything else up 48% this year? Not real estate, not stocks, not Bitcoin, nothing. And so that means that this is gaining in purchasing power against everything else.
Both governments and businesses are gravitating for hard assets like gold and silver due to pressures from debt, war expenditures, and currency devaluation. History tells us that true worth endures while fiat regimes inevitably fail. Gold is outperforming almost everything, and manipulation flaws are already visible, so the trend toward material wealth is quickening. Do you believe that governments will be able to conceal inflation this time, or will hyperinflation erupt like it did previously? If governments and large corporations began hoarding silver, how high could it actually rise? Feel free to share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.
We are at the end of a major monetary era, and this one is so big that it's going to end, sadly, a catastrophe for the world. This is why we went into gold investments for ourselves and for our clients at the beginning of this century, and we never changed our mind, and we're, as you know, only in physical gold and helping people around the world.
The way that Modi, who had been playing a two-step dance with Trump and with Russia and China, has now gone into a quick step right into the hands of Putin and Xi.
But isn't that telling us that, this is the end for the West, the end for the United States? Obviously, the EU will follow also.
What will emerge is that China is going to stand firm on tariff and trade issues.
We are at the end of a major monetary era that will end in global catastrophe, which is why they've stayed invested only in physical gold since the early 2000s. At the recent SCO summit, warmer ties between Modi, Xi, and Putin signaled India's shift toward balancing U.S. pressure, especially after friction over Russian oil tariffs. Analysts warn that U.S. deficits, trade wars, and eroding trust in the dollar could make capital controls increasingly plausible, with scope even warning of a potential U.S. downgrade. While there's little hard evidence of large-scale U.S. capital flight into Switzerland or gold, uncertainty is fueling concern that the dollar-centered monetary order is weakening as a multipolar world emerges. Key risks ahead include potential U.S. regulatory moves on capital flows, further rating downgrades, and rising demand for safe haven assets like gold as geopolitical and financial pressures intensify. The speaker, Egon Vaughan, the founder of Matterhorn Asset Management in Switzerland, in a crosstalk with Simon Hunt, is an independent strategist and consultant, warns that capital controls are coming to the U.S., with the dollar and financial system under attack. There are signs that confidence in the dollar is weakening. Investors are reacting to U.S. trade's tariff policies, rising debt, and political uncertainty, which in turn is leading to discussions about de-dollarization, diversification, and concern about the dollar's future role as the world's reserve currency. Figures like Robert Kiyosaki are warning of a looming central bank crisis. Egon and Simon suggest investing in gold, silver, and even Bitcoin, though often with caveats, as hedges against fiat collapse. Elevated inflation and weak growth plus geopolitical tensions are pushing institutional and private investors towards inflation hedges: gold, silver, real assets. Some analyses point out that usual safe assets, bonds, cash, may offer lower protection in this environment. Egon warns today's risks include banking crises, collapsing currencies, and rising social unrest, especially in the US. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I'm absolutely convinced that we will have capital. There will be capital controls in the US also. Dollar will be under attack. The financial system will be under attack. People want to transfer money out of dollars now are actually doing it now already. And we're seeing it. Americans reports about, especially the big banks in America, looking after wealthy families and individuals, that they're transferring a lot of money into Switzerland and also into gold, of course. There are not many places to flee to, are there?
No.
You got where you are in Uruguay.
Yeah.
Sorry, in Dubai, I mean. Uruguay is another one. From my point of view, I think Dubai is obviously fantastic now, but, it is next to the Strait of Hormuz. It can't be nearer than it is. It's so near. And, there has always throughout history and even throughout my lifetime been major conflicts in the Middle East. And, of course, then Dubai will be exposed also. For quite a while, part of my long-term forecast, I clearly saw at the end of the 90s already, and this is why I decided that we need to protect ourselves. You never know when it's going to happen exactly, and that's why we said, this is going to come. The end of a monetary era is coming. That's absolutely clear in my mind. Of course, we will have ups and downs. We will have stock market bubbles. We will have crashes. But, one thing I've learned, that to forecast price is a mug's game, and it serves very little purpose.
Equities is even a bigger mug's game.
Yeah. And therefore, what I'm more interested is in risk and in direction of the economy and therefore of markets also. And to me, already from the end of the 90s, I decided that the risk is absolutely at a maximum already, and it's going to accelerate and get worse. And therefore, you needed protection. And protection, of course, my point of view was there's only one asset that has survived throughout history and maintained its value, and that's nature's money, which is gold. All other currencies, as we know, have gone to zero. It's so easy. If you want to protect your assets, your old nature's money, and you know that at least, as in the case for thousands of years, you maintain your purchasing power. You might not always make a lot of money, but now when we've entered an era where governments are accelerating the money printing because the deficits is also accelerating, and now it's such an easy decision. I think this is the easiest investment decision I've made in my life. So, we recommended up to 50% in gold 25 years ago. And now I would recommend 100%, or we recommend maybe 25, 30% in silver. It's obviously putting all your eggs in one basket. But, it's like Rockefeller said, put all your eggs in one basket and look after the basket. and
I can't remember the name of the old Italian family, but there was a story of how they retained their wealth going back centuries. When wars came, They left with their gold and their art. They had title to the lands. And when the wars ended, they came back and they retained their wealth.
Yes, I think we are in that era now. Of course, everybody isn't wealthy and has art. Or in Venezuela, let's say, 25 years ago, if they bought gold then, the dollar was about par with the Venezuelan bolivar. Now, of course, currency is destroyed, the country is destroyed. And if they bought just a little fraction of an ounce of gold in those days, I mean, they would have saved them later. And the same today. People don't need to buy kilos or tons of silver or gold. They can just buy a small ounce, because I see now, I mean, this is going to accelerate. Currencies have gone down by 99% in real terms, in gold terms, since 71. It's just 1% to go. But that 1% is 100% from now. And that we are going to experience in the next few years, in my view. How fast it goes, it doesn't matter, really. Protection is more important than, as I said, forecasting the timing. You were talking about cycles of markets going up for a while and then going down. Yes, you're obviously into shorter cycles. In my world, we don't worry about that. We worry about protecting the risk that you have today. And there's so many black swans hanging above us. US banking system, for example. Civil unrest in America. We haven't talked about America. We talk about Europe. It's the same in America. I see civil unrest in a major way in America. It's already there. People are helping themselves, for example, taking or stealing any goods they want in shops. It's not just in America, happening in the UK also. Just walking in, hundreds of people walking into a shop, filling the bag, and they can steal up to whatever it is, $1,000. That's not a crime. And we are already into lawless society, and America will be very high on that scale of lawlessness, in my view.
Egon and Simon argue we are nearing the end of the monetary era, with the dollar, euro, and pound all in a race to the bottom. Forecasting gold in collapsing currencies is meaningless, only weight matters. The U.S. banking and financial system, built on endless debt and self-financed deficits, cannot survive, and capital controls are likely both in Europe and the U.S. safe havens like Switzerland. Dubai may offer some protection, but risks are everywhere. The bigger picture is the clash between the old US-led unipolar order and the rising multipolar world. This transition could end in war, or in financial collapse triggering political and military breakdowns, likely around 2028. The only real safeguard, they stress, is holding physical gold and silver as protection rather than speculation. Now let's dive into the interview.
Trump is moving the reservists into Washington,
Yes.
Chicago, etc., etc.
You talk about capital controls in Europe. I see exactly the same in the US. From my point of view, it's a waste of time trying to forecast which currency reaches the bottom first. There's no...
It's a race to the bottom.
Yeah, exactly. And there's no prize for being the first. They'll all be there, the dollar, the euro, the pound, etc. As we said, they're already 99% on the way. So it's not far to go. But that will happen too. And that will be the end of this monetary era, the way that I look at the world. And that's why protection
I'm
is
in
more...
complete agreement. Technical Associate has the dollar index, the DXY, halving by the end of 2028.
Yeah.
DXY is now about 97. We have it at 50 in 2028. What does that mean to the gold price?
Yes, and you get to the point, Simon, and I've been saying that for quite a while, that, it serves no purpose to measure the gold price in collapsing currencies because it's meaningless. You might as well measure it in chickens or cows or something more useful. I mean, gold and silver should only be measured by weight, really. How many kilos or how many ounces do you own? That's the only thing that counts. You know that you will maintain purchasing power. And if it will be $1 billion for an ounce of gold in a few years' time or $1 million or whatever, it's totally irrelevant because what's the value of the dollar at the time? And that's why, as I said, I gave up forecasting the gold price many years ago because it is a mug's game, and to forecast it in something that is sinking by the day serves no purpose. I mean, I see the US banking system, it's not going to survive in its present form, and nor is the European one, of course. So keeping money in the bank, I wouldn't recommend anyone to hold any money except for short-term spending money. If you have gold or silver, it's total liquidity. You can sell a gram, an ounce, whenever you want, and there's always a price for it. There's always a price. Yes, you talk about capital controls in Europe, but when I see clearly that the same is going to happen in the US.
I agree completely.
So where do people go? That's what they ask, of course. They don't want to be in the EU. I mean, Switzerland always has been a better and a stronger economy than the rest of Europe. Of course, Switzerland is under pressure from the EU. I mean, to the EU net, comply with more of the laws and the rules of Switzerland, is withstanding it. And of course, as Switzerland sees the EU collapsing, I sincerely hope and I believe that the Switzerland will definitely stay outside of the EU network. Whether Switzerland will be a bastion of safety and economic insurance in the future, I think it will, because it's a sounder people and sounder economy than most countries. But otherwise, go to Dubai, as you have done. And of course, it works very well for a lot of people right now. Uruguay is another country. Again, you're in the middle of a poor South America. You have Brazil and Argentina next to you. And when the bad times hit there, I mean, they are going to go to the rich countries like Uruguay.
Sure, yeah.
So that's a risk too. So you have a risk today that unprecedented. Of course, maybe the safest is to go to Russia or to China. But for Westerners, that doesn't feel right. US debt's never going to be repaid. And when you have a financial system with the dollar as the reserve currency, being in a country which is issuing massive amounts of federal debt on a daily basis, and there's no buyer of it except for the central bank itself, you're at the end. You know that if you both issue the debt and you buy your own debt, that is the
finished. Yeah.
ultimate of it. Oh, well, Ponzi schemes, isn't it?
Yeah. There's the question how all of this is going to end. Come back to where I started, that the real big picture is between the existing unilateral world that has operated for 80 odd years and the evolving multilateral world. It can only end in one of two ways. Either that the unilateral world, i.e. America, accepts that we are evolving into a multilateral world and therefore joins it. That's, under current conditions, is highly unlikely. Only other option is it's going to be war.
Isn't there a third option? America doesn't have to accept the dollar-based system at the reserve currency. It collapses. The financial system in the US collapses. The banking system collapses. Whatever desperate action they take with the whole Trump family now going into Bitcoin or cryptocurrencies and believe that that's going to be the savior of everything. That's not going to happen. In my view, cryptocurrencies are a bubble too, highly leveraged. And therefore, isn't there that third risk? I think that's a major risk, that it's actually led by the financial system collapsing in the West, probably in the US first, but it could be France or the UK starting. It doesn't matter why the trigger comes. Isn't that a very high risk to this system also?
Yes, it is. But the multilateral world and the unilateral world is not just a financial one, it's a political one too. And that's why I think there are only the two big options. Now, you actually given the trigger as to how this war between the two types of world will end by saying, rightly so, that the US and the Western system, financial system, is going to collapse. And in that collapse, you will then have political collapse.
And military collapse.
Everything collapse. And on my cycle timing, that is around 2028. That's only, where are we now, 3 years away.
That's like tomorrow. It's so intellectually so exciting to be in this era now, because, to discuss these matters and to try to not forecast exactly, but at least protect yourself and help investors around the world to protect themselves. And obviously with that comes helping family and friends and all of that. I see that as a major task of ours, and for people who are privileged that we are, because whether it's 25 or 28 or 29, it doesn't really matter. The risk is here and now.
If the US imposes capital controls, what options will remain for investors seeking to protect their assets? Could gold and silver alone provide enough protection in a scenario of systemic collapse, or should investors also diversify into other real assets? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.
The U.S. government has moved to impose tariffs on deliverable gold bars, reversing previous expectations that bullion imports would remain exempt under President Trump's reciprocal tariff structure. A July 31st CBP, that's the tariff organization, letter reclassified the bars as, quote, semi-manufactured, making them subject to duties under code 7108.13.5500. This decision sparked a surge in New York gold futures, where December contracts traded over $125 above London's spot before easing back into what you see there. Switzerland, the largest exporter of kilobars to the U.S., faces heightened trade pressures following a 39% country-specific tariff.
The U.S. Customs and Border Protection ruled that 1 kilogram and 100-ounce gold bars from Switzerland fall under a tariff-bearing category, overturning prior expectations of exemption. This threatens Switzerland's position as a central refining hub and could disrupt global bullion markets, making them subject to tariffs ranging from 10% to 39%. This move disrupted the international gold market, with the London-New York price spread surging to over $100 per ounce compared to the usual 30 cents. A major gold refinery in Switzerland halted deliveries to the U.S. following the CBP ruling. The change could fragment the global gold market, prompting buyers to shift toward non-Swiss bars at premiums. It also puts pressure on CME Group to address delivery issues for futures contracts. If upheld, the tariffs may reshape gold trade flows and force costly supply chain adjustments. Renowned market analyst Vince Lanci is known for his perceptive analysis of trading in commodities and precious metals. He discloses that certain huge gold bars, 1 kilogram and 100 ounces, are currently subject to tariffs from the United States. These bars are frequently used in EFP transactions as well as wholesale bullion trade. UBS is cautioning that the increased costs of these U.S. taxes on massive gold bars may lead to a mass closeout of short exchange for physical positions, which could cause disruptions in the funding markets. The unwinding of these trades, which are typically settled in London, may complicate funding circumstances because it would create an unexpected demand for cash and liquidity in the city's bullion market. The apparent decision by the U.S. Customs and Border Protection Agency, announced privately in a letter to a Swiss refiner on July 31st and made public on Friday, sent gold futures in New York soaring to a record, as insiders warned that the tariffs would have dire consequences for the market. Then, just as quickly, prices tumbled after the Trump administration suggested imports of gold bars wouldn't face tariffs after all. In the 12 months to June, Swiss exports of gold to the U.S. were worth approximately $61.5 billion. Switzerland's rate is among the highest in the world, after Brazil, Syria, Laos, and Myanmar. According to reports, gold bars were in such high demand in the U.S. in May following Trump's announcement of sweeping reciprocal tariffs the previous month that Costco capped the number of gold bars that could be purchased in a day. Let's jump into the video for more details. If you like what you see, please give us a thumbs up and subscribe to our channel to stay updated on our latest content.
Refiners in Asia have also paused shipments as uncertainty spreads. Industry experts warned the move could destabilize the gold futures market's pricing function, with UBS and BNP Paribas strategists questioning whether the ruling was an error or a fundamental policy change. To put a little bit of color on the mechanics of what is going on and why this is affecting the market the way it has, before giving you a very simple big picture overview. London deals mainly in 400-ounce bars. U.S. contracts are for 1 kilogram or 100-ounce bars. During COVID, the problem that's happening right now also arose. When there is demand for U.S. delivery, London bars are sent to Switzerland to be re-refined or refabricated into U.S. formats. London has been the default physical hub for gold for decades, while the US has focused on making a more robust futures market. Dealers in London are typically long metal in their vaults in London and hedge by being short US futures through the EFP carry trade. They are long London gold, 400-ounce bars, and short US gold, 100-ounce bars. If US delivery is called, which historically is rare because the COMEX is a paper market, and everybody knows that you should want to get your metal from London, they would take the metal that they have, their 400-ounce bar, send it to Switzerland where the refineries are, have the Swiss break down the 400-ounce bar into 4 100-ounce bars, changing the format, satisfying US rules. The new tariffs disrupt that trade. A London trader, long gold and short US gold, long London gold and short US gold, now faces a choice. First of all, London traders have been doing this for years. They're long the physical and they sell futures against it legitimately to carry the differential. It's kind of like lending money out. Gold is money. And they get comfortable doing that. And it gets to be a crowded trade. It gets to be a lopsided trade. And so they have these large legacy positions that they're always massaging. But when news like this comes out, and you can't take your 400-ounce bar and put it into 4 100-ounce bars to ship it to New York if someone ever wants the physical, you have a problem. You can find another refiner, not possible overnight. I wouldn't give you any. Squeeze the shit out of you, excuse me. You could do nothing and die a painful death, or you can buy back the US contract quickly. So they're short the US and they're long London. So they buy the US contract quickly, and then they decide whether or not to sell the London contract. So it's a regulatory contract issue. If somebody in the US were to say, I want the gold, as we have been doing, well, then you would have to get the gold. The driving behind the price higher is this covering or this unwinding of the EFP, which is really just a spread between London and New York. This exposes the weak link in the triangle of trade, London. London acts as an intermediary, but problems in metals markets over the last 5 years, gold, silver, and nickel, for example, and copper, have been venue or fungibility problems. Again, very similar to what happened during COVID. Supply chains that are too long are being shortened. Now, to zoom out on a little bit of a big picture thing here, because this is all part and parcel of what's been going on over the last 3 years.
Vince points out that the conventional relationships between the US and London gold markets have been upset by this sudden action. There was a notable pricing disparity, as New York futures reached all-time highs, while London spot prices remained essentially unchanged. For example, London spot prices closed at $3,439.10 per ounce, while December gold futures hit $3,534.20 per ounce. The White House announced that it would issue an executive order to clarify its tariff position in response to market turbulence. The goal of this action is to clarify any confusion and establish stability in the bullion market. The current state of affairs underscores the intricate relationship between international commodity markets and trade policies. As the US administration seeks to assert its stance on gold imports, the broader implications for the gold market and its participants remain to be seen. The White House's upcoming executive order should hopefully clear things up, said the logistics source. Protecting the US gold futures during this uncertainty are high stocks of gold in COMEX-owned warehouses after massive inflows over December-March as traders hedged against the possibility of broad US tariffs hitting bullion imports. The COMEX inventories currently amount to 86% of open interest, against a more normal 40 to 45%. So there is no liquidity issue at present, said StoneX analyst Rona.
Copper earlier, London spot prices were largely unaffected and are now lower. This reflects the weakest link in the triangular gold trade between London and the United States, as I just said. Moving on to the immediate potential effects. If the move is intentional, it is a game of chicken with the potential to disrupt the gold market at the financial side substantially. The negotiation is with Switzerland, but it highlights that Western gold's trade weak point is physical supply in London, while Western demand is increasingly in the US, pulling the gold over here. The supply chain must shorten. Because gold is also money, restricting its movement is weaponizing our payment chain. If unresolved quickly, this will push market participants into their own corners, taking their kickballs and going home, but more aggressively, make global trade more fragmented and bilateral with every deal negotiated separately. If Trump meant to do this, he could still adjust course, as he recently did with copper, depending on the reaction. The Swiss have already offered, as we said, at least verbally, to consider moving refining capacity to the US. It is unclear how serious that is. If it was unintentional and the result of a classification error, or Trump just bluffing to see how they'd react, the decision could be reversed within days. For now, given the opportunity, this is effectively a coin flip. Traders might use this as a point to close positions, winning or losing, until there is clarity. The implications are significant, but the core story is here. Related posts. By the way, that full story is in Tariff Shock Triggers Historic Gold Market Location. The link is there. Related post. Last night we put it out. U.S. imposes tariffs on Swiss gold bars. Yesterday we also put out UBS raises the 2025 demand roof. Suspicious, no? Founder special, Fed death, gold industry coming to America, as we thought would happen. Swiss offer U.S. its gold industry and trade talks, and the must-watch report from yesterday. Okay. We have a little note here we just want to say. Isn't it interesting? I won't say the word suspicious, that within days of each other, the Fed weighs in on gold revaluation. The LBMA is exposed as a weak link while we're trying to repatriate our own gold supply industry. These things point to potential revaluation of gold. They definitely point to a deepening and a realization of the importance of gold in global trade going forward. They show the LBMA problems, and we need to secure our payment and supply chains for gold if we view it as an international asset that's needed. Other metals would follow. In 5 minutes, he could reverse this and say, I didn't mean it. And you could think that he's either screwed up or bluffed. And you'd say he's a dummy. Or, and this is equally true, Trump has a habit of, most government does, but Trump has a habit of shooting and then aiming. So perhaps he shot and aimed because he wanted to see how they can react. You know, when you're the incumbent, you get to make those mistakes. That's why Microsoft software sucks, because they can put it out and then fix it later on. Anyway.
This steep tariff on Swiss gold bars marks a significant escalation in U.S. trade policy, potentially reshaping global gold flows and driving up domestic prices. With high demand already evident, as seen in Costco's purchase limits, the new levy could further tighten supply and increase costs for American buyers. How might these tariffs impact gold prices in the US over the next year? Could this lead to increased smuggling or alternative sourcing of gold? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.